All right, good afternoon, everybody. Welcome to Sharpen Your Edge, Learn to Trade Fearlessly. This is session 20. Can't believe we're already up to session 20. And we're going to be going over VPA Chapter 10. This is Volume Price Analysis by Anna Colling, a complete guide to volume price analysis. This is really book one of it. And it is not volume at price. This is just review. That's from last week's slides. I changed that, not sure why that's there. In a bull market, it is better to always work on the bull side. In a bear market, on the bear side. Quote from Charles Dow. Okay. As we near the end of this book, I'm going to cover some examples from various markets and from different platforms. All have volume. All of them have one thing in common. The application of VPA is identical in each case. And I'm going to start with some examples from the U.S. stock markets. And the first, well, of course, Anna says U.S. stock markets because she's in England. But the first chart we're going to do is Honeywell. And this is a nice example which teaches us a number of lessons. While this is a daily stock chart, our VPA principles still apply regardless of the market or the instrument. As you can see in the beginning, the stock sells off, moving lower, and initial weakness is signaled by the small shooting star candle, which is then confirmed with rising volume and a wide spread down candle. So no anomaly here. This then is followed by a narrow spread down candle with higher volume than on the previous bar. This is an anomaly and could be stopping volume. The following day, the market closes with a hammer candle and high volume. Again, we're now looking for this stock to pause at this level, perhaps move into a congestion phase or see further accumulation before a breakout or move higher. See if I can get out my charts here. There we go. And then move higher. In this case, Honeywell moves higher immediately on the following day with a gapped up open, which is here. But the volume is only average. The following day, the price spread is narrow, and although higher on the day, the volume is falling away. This is not a good sign and suggests weakness. Rising price and falling volume is a sign of weakness. The stock is possibly not going to move too far and does rotate into a congestion phase. Okay. However, towards the end of this phase, we start to see daily selling pressure absorb with a narrow spread. However, towards the end of this phase, we start to see daily selling pressure absorbed with a narrow spread down candle and high volume, an anomaly. After all, if this was selling, then we'd expect to see a wide spread candle, and we haven't. We have a narrow spread candle followed by another 3 candles later. Okay, the selling is being absorbed, and we are now waiting for a potential breakout from this region, which duly arrives. There's a little breakout from that session. Rising volume with right spread up candles, a positive signal the market is bullish. We also have a nice platform of support below. The market then moves sideways again at the higher levels for 2 weeks, sliding lower, but note the down candles. The selling volumes are falling all the time at this level, not a sign of a bearish market. If the stock were truly bearish, we'd expect to see falling prices and rising volume. We have falling volume. Remember, it takes effort to rise and fall. Therefore, we're expecting to see buyers come into the market soon, which is precisely what happens next. Absorbed selling was there. Then we get our breakout here. And with attitude, the buyers come in with above average volume. Note the tail on this candle, which is the last in the current congestion phase. Which I believe is that one. This looks positive. The following day, we get the breakout with high volume right here, gap up, breakout, right in here with high volume. This is not a trap up move, but a genuine move higher. And we know it is genuine because volume reveals everything. Not only have we seen a breakout, but this has been accompanied by a gap up, this has been accompanied by a gapped up open as well. All signs of a bullish market provided this validated with volume. So we can see we're gapping up. We had our gap here on the day, and we are pressing up, and we see relatively higher than average volume coming in. Okay. That is not end of slideshow. Excuse me. Been having problems with my slides and my slideshow. Okay, so the next chart we're going to look at is silver. And I now want to consider a different market and time frame. And the first example is SLV, which is an ETF for silver. ETFs are a very popular way for many traders to enter the commodity market, and the SLV silver is currently one of the most popular. It is a straightforward ETF, unleveraged, and is backed by the physical metal. Here we have the 5-minute chart, so perfect for our intraday scalping strategy. As we can see from the chart, starting at the far left, let me get my tool starting at the far left, boom, over here. Starting at the far left, the SLV has been moving sideways, albeit with a bullish tone before starting to fall, breaking below the interim platform of support, which is 5 consecutive down candles on rising volume. A signal the price action was being validated by volume, which at this point is above average. Hard to see the volume down here, but the average is above. Then silver then drifts sideways for a few bars before we see 2 narrow spread candles. The first with above average volume, an anomaly, and the second with extremely high volume right here. This is the place where the yellow box is the place we're looking at. This must be stopping volume and therefore buying, otherwise the candle would be wide. Instead, it is narrow. This is followed by the hammer candle on high volume, signaling more buying in the market. The response is muted with the up candle, which moves higher on low volume, not a sign of strength, but it's followed on the next candle with rising volume and a widespread candle. So an encouraging signal. The insiders then test on low volume and move higher on solid volume before weakness starts to appear with a widespread up candle and a subsequent failure at the same level. What happens next was that silver then drifted along at this level for some time before selling off again the next day. It would be very easy for me to show you hundreds of examples where VPA gives us great trends and great trading opportunities. It does. But what it also does is gives us sound common sense logic on which to base our trading decisions. And more importantly, to quantify the risk on the trade itself, which is what trading is all about. Okay. Okay, next thing we're going to look at is gold 15-minute. The next example is another extremely popular commodity for traders, gold, and the ETF is the gold fund. Once again, Anne has taken a faster time frame here to use an example, and in this case, her commentary is on a candle-by-candle basis with no annotation. The reason for this is the chart would simply be too cluttered. Before starting, let me put the gold market into context for you. At the time of this chart, gold had been weak for some time, and in a low inflation environment with high returns in risk markets, money flows in general at this point was away from safe havens. Money flow in general at this point was away from safe havens. The longer term trend for gold was therefore bearish. This is the context against which to view this intraday price action. The market opens gap down right here. There's the gap, and there is the gap down. Opens up gap down on extremely high volume, a clear sign of weakness. We are starting with weakness, which has been validated by volume. The next candle forms a small hammer again with ultra high volume. Is this stopping volume? Well, maybe. But perhaps we wait for the next candle to form. A small candle with an upper wick suggestive of further weakness and coupled with high volume. Okay. Clearly not a positive response to the stopping volume. The next two down candles suggest a modicum of buying on each, with the lower wicks showing some support in here. But the market continues lower on rising volume, with the penultimate candle suggesting stopping volume once again. Finally, the last down candle in this price waterfall closes on average volume right here, followed by the first up candle of the session. A weak response, if ever there was one, with a deep upper wick and narrow spread with above average volume. This is hardly a market preparing to reverse at this point. The next candle is perfectly valid, a narrow spread up candle with average volume. This looks fine. Then we see a repeat of the first candle in the sequence of up candles, but this time look at the volume. It's extremely high down here. This is sending a loud signal the market is very weak. If this were buying volume, the market would be rising fast, but it isn't. So it must be selling volume. Everyone is selling and trying to get out of the market before it collapses, with every attempt to rise knocked back by the pressure of the selling. The next candle is even worse. The next candle is even worse, sending an even stronger signal. If any were needed, that everyone is selling and the market is now incredibly weak. Here we have ultra high volume and a market that is going nowhere. The price spread is narrow, and if the volume were buying, then the market would have risen. The insiders are propping the market up, selling stock accumulated in the price waterfall before taking it lower. The next two candles gives no clue. Narrow spread with low volume, then the market sells off sharply as expected and validated with ultra high volume. That is actually this candle and the accompanying high volume right there. The next candle hints at stopping volume again with a narrow spread, deep wick on very high volume. The buyers are moving in at this level, which is repeated on the next candle with high volume again on a narrow spread. Now, we should see the market recover, but look at the next candle. The market attempts to rise, but falls back to close near the open of the above average volume. So that is here, starts to open and then closes again at the above average volume right there and volume right there. Not a strong signal. A small hammer follows right there on ultra high volume. So perhaps there are more buyers in the market, and based on the volume of the last few bars, a possible reversal is now the prospect. Three bullish candles right here then follow, each with a narrow spread, but the volume is flat. Okay, but the volume is flat. So we have a market rising on flat volume and therefore unlikely to go very far. The market reverses from this level, and as it falls, volumes are increasingly signaling selling pressure once more. The final candle in this sequence is a very narrow spread doji candle. That must be the very spread doji candle with high volume. Yeah, that's the narrow spread doji candle. There is the high volume there. And again, we can assume this is stopping volume with buyers coming in once more. This is confirmed with the next candle, which is a widespread up candle with above average volume. But as the market rises on the next two candles, volume is falling away. The insiders are not taking this market fall far. The market then drifts sideways for an extended period in the session, with several attempts to rally all failing. And with volumes generally falling to low levels throughout the phase, the market duly closes looking very weak, which is in here. What happens in the following day's trading session is the bearish tone of the previous day and was taken up in dramatic fashion as gold opened gap down again on 3 times the volume of the previous days. Open. So that is gold, and that's the VPA of that. And let's move to our last example here. All right, this is the E-mini 5-minute chart. So let me get my drawing tools. All right, so what do we see here? First, we have a gapped up move as the cash markets open. Okay, volume is high, and a nice widespread up candle closes the first 5 minutes of trading. So we have our gap up here and our first widespread up candle closes the first 5 minutes of the trading. The big operators are joining the move. The next two candles are down right here, but volume is falling. As we can see down here, volume is indeed falling. So we do not expect the market to move far. And indeed, the lower wick on the second of these candles is a clue that this is simply some early profit taking on the gap up open, and the buyers are in control. From there, the market moves steadily higher, as we see here, with some rising volume. There are no signals of reversal, just a steady rise with minor pullbacks. But each time we see a little wave lower, this is balanced by a wave higher in the volume trend, which is what I was trying to describe earlier. You do have to be flexible in how you view volume in rising or falling trends. What is interesting here is that if we compare the first wave with the second wave in terms of the buying volumes, volume on the second wave in the up move are slightly lower than the volumes in the first wave. So we may begin to think that perhaps this move was running out of steam and possibly time to exit the trend. However, there's nothing particularly frightening in any of the subsequent price action. And indeed, as we can see on the right side of the chart, the down candles have very low volumes. But interest appears to be waning, and we need to be vigilant. Remember, volumes at the open are generally much greater and tend to fall away naturally after the initial surge of future contracts as the cash market opens. So a general decline is normal and part of the intraday volume patterns. Rather like the winter sales, the doors open, the bargain hunters rush in, and once the initial surge is over, volumes of shoppers then settle. It's the same here. One further point on this chart before we move on. The move higher after the first few candles of the open would also have given us confidence as the index broke above the initial resistance area created at the open. This is only a secondary resistance level, but nevertheless, another confidence builder for us in taking a position in this market. The same applies at the right-hand side of the chart as the market moves into a congestion phase. And coupled with a general decline in volume, this may prompt us to exit this stage as resistance builds. So we've got a general rise here. We've got some rising volume, but generally about average volume. And then this final push here on this volume right here on this candle with a low side wick shows us we're going to have a little, well, we're getting, it's it's telling us that we're probably getting to the end of this rise, and indeed that's what happens as we get into congestion and go sideways the rest of the time. So those are the 4 examples of price I wanted to show you. So in the next chapter, we're going to want to highlight some of the price patterns we believe help give an additional pointers and guidelines in our analysis of price action and the associated volume. We have basically just 1 chapter left to go, so we're really just in review phase. So that's it. That is our review for the day of 4 charts, excuse me. Any questions? Okay, so what I found, guys, on volume price analysis is that this works better on higher volume. Let me let someone in. Let a couple people in there. Didn't see them. For our type of trading, volume price analysis is better in the 5, 10, and 15-minute charts rather than our 1-minute chart. The 1-minute chart just moves too quickly for volume price analysis to be really of much use to us. But the bottom line on volume price analysis is when we see higher volume, we should see higher moves, larger candles in it. And that can work for either bearish or bullish candles. But the bottom line with VPA is, for candles to move, we need more volume to do that, which has been part of our strategy for 6 years now. So when doing VPA, the basic rules are the higher the volume, the more we should see candles move. If we don't on higher volume, it's an anomaly, and we shouldn't use that. Well, we do use that to make a decision on whether to get in or out of a trade. But when it's an anomaly, we want to avoid using that as legitimate information when we're considering getting in and out of a trade. Okay, that's it for that. I'm going to